What if I told you that one simple decision could either delay your financial freedom by years or supercharge your wealth for the future?
In today's video, we're tackling one of the most debated financial dilemmas. Should you overpay your student loans or invest money in the stock market?
Stick with us, because by the end of this video, you will not only have a clear answer, but a strategy backed by numbers, research, and real-life scenarios to help you make the smartest move for your financial goals.
And while you're here, tap the like button, guys. It really helps us to reach more people like you. Thank you.
We are Ken
and Mary
of the Humble Penny and Financial Joy Academy. We achieved financial independence age 34, including mortgage-free, in 7 years.
We're also Sunday Times best-selling authors of Financial Joy, a 10-week plan to help you banish debt, grow your money, and unlock financial freedom. We'll link to it below and above for you to check out. XTB sponsors today's video, and we'll share more about them later.
So here's the plan, guys, for today's video. We've got a few parts to cover. So part one of today's video, we'll look at the context and framing of the problem when it comes to student loans. Part two will be all about the numbers. So when to overpay versus when to invest in the stock market. Part three then is how to figure out what salary overpaying makes sense for you personally. And part four, we're going to bring in some research-backed insights, guys.
Part five is a bonus tip. Is taking out a student loan still worth it? Make sure you stick around for this. Part six, we're going to be looking at other considerations, and in part seven, we're going to conclude. So let's dive straight in and start with part one, context and framing the problem.
Okay, so student loans can feel like a dark cloud looming over your finances.
Oh yeah.
But not all loans are created equally. So let's quickly break this down for you guys, because there's so many different plans. If you are on plan 1 or plan 2 or plan 4, or even the new plan 5 in the UK, your repayment terms, like your interest rates and thresholds, matter massively when deciding whether to overpay your student loans.
Yeah. And then there are the postgraduate loans, 6% repayments above £21,000 income, which can add an extra layer of complexity. Here's the big question. Should you focus on clearing these loans or take advantage of the stock market's wealth building potential?
Now, this decision isn't just about numbers. It's about understanding opportunity cost, tax implications, and even your lifestyle goals. Plus, the right choice might actually surprise you.
Absolutely. By the way, let us know in the comments, what's your biggest financial goal right now? Is it paying off your debt or is it building wealth? Would love to hear your thoughts. Part two, the numbers, when to overpay versus invest.
All right, let's dive into it. This is what everybody's waiting for, right? So let's break this down for each type of student loan plan, starting with plan 1. Now, if you are on plan 1 for loans taken out before September 2012, your repayment threshold is £24,990 as at the moment, and you pay 9% of any income above that. The interest rate is the lower of RPI, currently 4.3%, or the Bank of England's base rate plus 1%. Now, for most borrowers, this means a very low effective interest rate, often below the RPI inflation rate.
Yeah, and with such low interest rates, the opportunity cost of overpaying is significant. Investing that money instead could yield far greater returns over time. For example, £2,000 invested at a 7% annual return could grow to over £15,000 in the 30 years that a student loan could get written off.
If you are finding this video insightful, please take a moment to hit that subscribe button so you don't miss actionable tips like the ones we're sharing here on today's video. Now, before we discuss what to do for Plan 2 student loans, let's take a moment to talk about a tool that can help you get started with investing, XTB.
XTB is an award-winning investment platform that lets you invest in stocks and ETFs, a flexible stocks and shares ISA, and offers 4.75% interest on uninvested funds with ease. Now, their investment plans feature is perfect for beginner investors, offering low-cost investing and pre-built portfolios tailored to your goals and risk level.
Now, whether you are just starting out or you are looking to grow your wealth, XTB gives you the tools to invest smarter while managing your student loans responsibly.
So why not grow your wealth while paying down your debt? Once you open your account, you can create a plan in no time with 4 simple steps. Step 1, choose your desired ETFs. Step 2, allocate your funds. Step 3, make a deposit. Step 4, put your money to work.
Check out XTB's investment plans today using the link in the description and get your money working.
Now for Plan 2 loans, which are loans taken out from September 2012 to August 2023. The threshold is currently £27,295 and interest rates range from RPI, which is currently 4.3%, where income is £28,470 or less, rising on a sliding scale up to RPI plus 3%, which is 7.3%, where income is £51,245 or more. Now, if you're a high earner, your loan interest rates could be 7.3% or more, making overpayments more attractive.
Yeah, that makes a lot of sense. Now, for postgraduate loans introduced from 2016 onwards, the repayment threshold is £21,000 with an interest rate of RPI plus 3%, which is currently 7.3%. Overpaying makes sense here as it's harder to beat a guaranteed 7.3 return by investing in the stock market.
Finally, Plan 4 loans, primarily for Scottish students, have a threshold of £31,395 at present and an interest rate similar to Plan 1, making overpayments less urgent. Investing would make sense here.
And for the guys who have the Plan 5 loans, these are loans taken out from September 2023 onwards. The repayment threshold at the moment is £25,000 and the interest rate is pegged to the lower of RPI, the Retail Price Index, or the Bank of England's base rate. Now, these loans also have a repayment term of 40 years, so many borrowers will pay over a longer time frame. Now, given the lower interest rate compared to earlier plans that we talked about and the extended repayment term, overpaying is less urgent unless your income is significantly higher than that threshold.
And higher earners who expect to fully repay their loan will accrue less interest and fully repay their loans in fewer years. Investing might offer better long-term returns, especially for borrowers unlikely to fully repay the loan within 40 years. Up on the screen is a summary table showing the different student loans plans and whether you should consider overpaying the student loan or investing in the stock market. Feel free to pause the video here and read it in detail.
Yeah, so lots covered there on that table. Let's look at a worked example and make this real, right? So let's assume Anna is a 32-year-old marketing professional earning £40,000 a year with a Plan 2 loan of £50,000. Anna is deciding whether to invest an extra £2,000 she has in an index fund or use it for overpayment of her student loan. Now let's look at scenario 1, which is overpaying the loan. Now in this case, Anna's Plan 2 loan accrues interest at RPI plus 3%, which is currently 4.3% plus that 3% giving 7.3%. Her loan balance of 50k therefore accrues interest at 50,000 times 7.3%, which is £3,650 per year. Now, she pays 9% of her income above £27,295 thresholds, which is £1,143 per year. I'm sure you've noticed this. Critically, her annual repayments at that 40k salary do not cover the interest accrued, meaning the balance grows and continues to compound yearly. Now, by overpaying £2,000, Anna reduces her balance, saving interest on the amount at a rate of 7.3% per year. Now, using the future value formula, we calculated the difference in the loan balances after 10 years. And this is what we found out, guys. The future value of her original 50k at 7.3% will be £101 £8,150. Now, if you take away the 2k from the 50k, the future value of 48k at 7.3% is £97,104, making the difference that she saves to be £4,046. It's worth mentioning that this assumes that RPI remains at 4.3%, which will obviously change in the future.
Scenario 2, investing the money. Anna invests the £2,000 in an index fund with a 7% annual return. Over 10 years, her investment grows to £3,934. While investing directly yields significant returns, the savings from overpayment at £4,046 indicates that overpayment becomes more attractive when interest compounding is factored in. This analysis suggests that overpayment of the student loan may be the more beneficial option in this case, given the assumptions we've made about RPI.
Keyword there is maybe. Right?
Maybe.
Now, what if Anna earned, say, £80,000? Now, in this case, with a Plan 2 loan for Anna in this example, overpaying starts to make more financial sense as her salary increases significantly, especially above £70,000 up to about £80,000.
Yeah, at £80,000, Anna's higher repayments mean she's more likely to pay off the loan before it's written off. This makes overpayment slightly more attractive, but investing can still offer better long-term growth depending on her financial goals. For example, working towards financial freedom or optional early retirement.
Yep.
And if she can achieve higher returns on her money invested in a tax-efficient way.
Love that. Let's now look at part 3 of this video, which is how to figure out what salary overpaying makes sense for you, right? Now, to determine at what salary overpaying your student loan makes sense, let's follow these very specific steps, which we're going to outline. So step 1 to think about is know your student loan details. Don't ignore them, guys. So identify your plan type, whether it's plan 1, 2, 3, 4, or 5, and its specific repayment thresholds and interest rates. Step 2 is then to calculate your annual interest on your loan. So multiply your remaining balance by the interest rate. For example, if you owed £50,000 and the interest rate is 7.3%, you'd simply say 50,000 times 0.073, which in this case would be £3,650 per year.
Step 3 is to calculate your annual repayments. So subtract your plan's threshold from your income and multiply the result by 9%, so repayment rate for most plans. For example, at £80,000, income with a Plan 2 threshold of £27,295, you will get £4,743 per year. Step 4, compare repayments to annual interest. So if your repayments are higher than the interest accrued, you're reducing your loan principal. At this point, overpaying may be more attractive as it reduces future interest faster.
Yeah. Then step 5 in this process is to factor in loan write-offs. This is very important. So consider whether you are likely to fully repay the loan before it is written off, which in this example is 30 years for a Plan 2 loan. If it's unlikely that this would happen, then investing may still offer a better long-term benefit. Let's now look at part 4, which is some research-backed insights. So we did a bit of research on this topic, obviously. Let's bring this into the picture. Studies show that the stock market's return, long-term average return, is about 7 to 8% per year. Compare that to the interest rate for each loan plan.
For Plan 1 and Plan 4 loans, the interest rates are typically lower than a stock market's average return, making investing a better option for most borrowers. According to the Institute for Fiscal Studies, the majority of Plan 2 borrowers won't fully repay their loans before they're written off, i.e. they'll pay a lot of it, but most people wouldn't fully repay it.
That's really insightful, isn't it? That most people will not repay.
Yeah.
Now, this means that overpaying might not always be the best use of your money unless you are a high earner with a high interest rate. Now, for postgraduate loans, however, the current RPI plus 3%, which at the moment is 7.3%, is actually quite hard to ignore. So overpaying might save you more in the long term if you're scheduled to pay it off before it's written off.
And let's not forget, if having debt stresses you or affects your mental health, prioritizing overpayments might still be worth it, even if it's not a mathematically optimal choice. Let's look at part 5, which is the bonus tip. Is taking out student loans still worth it?
This is a big topic because a lot of people think student loans are a scam. Right? We ran a poll actually, which we put up on the screen for you guys to see. Now, with all these changes with student loans, especially with the introduction of Plan 5 from September 2023, is a student loan, taking out a student loan still worth it?
So here's what's changed. Plan 5 loans have a lower repayment threshold of £25,000 and a repayment term extended to 40 years. While the interest rate is pegged to RPI or the Bank of England base rate, whichever is lower, the longer repayment terms means many borrowers will pay more over their lifetime. The IFS said, we estimate the share of graduates fully repaying their loan will increase from 49% for the 2022 university entry cohort to 79% for the 2023 entry cohort. That's a big difference.
That says a lot, doesn't it?
Yeah.
79%, guys. Now, that said, student loans still offer unique benefits. They don't affect your credit score. Repayments are income contingent, so it feels like effectively a graduate tax. And any remaining balance is written off after the repayment term. For many people, it's still the most accessible way to fund higher education.
However, with rising tuition fees and changing loan terms, it's more important than ever to weigh the costs against a potential return on investment. Think about your chosen field of study, expected salary, and alternative funding options.
100%. And in some cases, considering things like apprenticeships or employer, sponsorships or part-time study might be a smarter way to avoid excessive debt whilst gaining valuable skills.
Yeah.
Now, let's look at part 6, which is other considerations in this picture.
Non-financial factors also play a role. Think about job stability. If you're in a stable career with a regular income, investing might feel less risky. But if your income fluctuates, reducing debt gradually could provide peace of mind, although not that relevant with student loans, especially if you earn below the threshold.
Yeah. And don't forget life goals. This is what our channel is all about, right? So are you planning to buy a house, for example, or maybe planning to start a family, or do you want to travel the world, for example? It's very, very important to align your financial strategy with your broader aspirations and goals for the future.
Also, emergency savings are crucial. So before investing or overpaying, make sure you have at least 3 to 6 months of living expenses saved. And this is your financial safety net. It's also worth mentioning that things will change in the future. For example, RPI rates will increase and decrease, and so will your investment returns, and so will your income. So assessing periodically, for example, every 12 months, whether you should overpay your student loans or invest as your circumstances change is a good idea.
Okay, let's now look at part 7, which is our conclusion. So should you overpay your student loans or should you invest in the stock market? The answer, as I'm sure you figured out, depends on a number of things: on your loan terms, your current and future income potential, how far away you are from potentially getting your loan written off, your financial goals, and how comfortable you are with taking risks.
Remember, investing isn't about time in the market, it's about time in the market for the long term. And the key is to get started today.
If you found this video useful, guys, hit that subscribe button. We've done a lot of work and I hope you really enjoyed it. So you don't miss any future actionable tips just like this one.
And before you go, watch our next video, Pay Off the Mortgage or Invest. The smarter move explained with maths. Trust us, guys, you won't want to miss this one.
Thank you guys a lot for watching today's video. And as always,
in all things, be thankful and seek joy. Take care, guys.
Bye.